Altria Group is currently down 9% over the last 12 months. It's trading towards its 52-week lows with a current forward yield of 9.54%. It is one, for full transparency, that I do hold in my own portfolio. So let's find out if it is still a strong undervalued buy with an incredible yield, whether it's an opportunity or it is a potential dividend trap. Now we're going to do a full in-depth deep dive of this company. We're going to look at their top line revenue growth as well as their bottom line net income year on year over the last 10 years, as well as our typical health check of any company, their total cash versus their total debt. We've got a lot more information to go through, as well as both insider and institutional ownership. And what we want to look at, very importantly, for a company with an incredibly high yield is that dividend safety. We want to talk you through it. And also there are a few things that we want to look at their more recent earnings conference call. And we don't just want to look at the positives, we also want to look at some negatives and what regulatory risks there are heading for this industry as a whole as well. As always, we will take a look at the valuation model. We'll get to our own intrinsic value, look at our acceptable buy price given that investor margin of safety, and also conclude on Wall Street's forecast projections over the next 12 months. So let's jump straight into the historical performance of this company. We can see the tobacco industry as a whole has performed very poorly. Altria down 9%. When we extend it to the last 10 years, you would be up 5% if you were a shareholder for the last 10 years. It would be slightly higher if you did reinvest those dividends, as this does not include those dividends reinvested. And we see all-time highs sitting around $78. You'd have to go back now nearly 7 years. So a lot of things to comprehend with this company. Firstly, out of the analysts, we have 2 holds and we have 1 buy rating, notably Seeking Alpha Analyst. Now, in terms of looking at that forward PE, it is around 8.04, so it is very low when you do compare it to others in the industry, but we will take a look at that later on in the episode. So in terms of the company, what is the direction? Now, top line growth, what we want to see typically steady, mature companies like Altria, 3 to 7% growth year on year. What we can see, 10 years ago, they reported just under 18 billion on their top line. Their most recent annual accounts, 20.5 billion. And what we can see when we do look at it on a graph basis, there is relatively little movement over the last 10 years. When you factor in inflation, you will notice that in fact in real returns on the top line it is decreasing. But again, this is a tobacco industry. It is an industry where the top line of the majority of companies are starting to slow down, and we will factor that into our analysis. Bottom line, well, 5.1 billion reported in December 2014, 8.1 billion in December 2023, and we can see it is fairly inconsistent over the longer term. What we would typically like to see is increasing revenues as well as increasing net income over the period. Now, when we take a look at the health of this company, very important, a very quick check, total cash and short-term investments versus total debt. They had 3.3 billion of cash in 2014. Latest annual accounts, 3.7 billion. So relatively little movement, and as we can see on the graph, again, very inconsistent. It isn't a red flag indicator, but what is good to note is how large that cash balance is in comparison to their total debt, and to see that movement numerically and directionally. Now, in terms of that movement, what we can see, total debt, it has in fact increased from 14.7 billion to their latest annual accounts of around 26.2. And when we look at it on the graph, whilst the cash has been a bit more inconsistent, total debt over the longer term does look to be trending up as an increase. Not a massive red flag indicator, but something just to incorporate when we look at that dividend safety, as that will affect that. In terms of their growth metrics, a few just to point out, it does get a D rating, not great at all. Revenue growth year on year, now it is negative, as we see here, negative 0.9%, with other companies in the sector, in the tobacco industry, up 3.5%. When we look forward rating, pretty much flat, whilst we see others up 4%. And when we look at both EBIT growth year on year as well as EBITDA growth year on year, they are lacking severely, in fact negative versus the industry, which we do have as mid-single digit growth. So something to factor in, as well as the fact that the earnings per share on a forward basis, so this is 3 to 5 years, on average every single year, has been increasing at 4%, whilst we do see others typically around 8%. Now, there is more to the company than just looking at these grades, but these are very high level metrics. Profitability grade, much better. In fact, the highest grade you can get. A+. Now look at this, 69.53% on a gross margin basis, significantly wiping out the competition around 35%. On the bottom line, very important, 40%, whilst others in the industry around 5%. So we can see now why on the profitability they do have some very, very strong marks. Now, what I always like to do very quickly is compare them to how their competitors have fared in the industry. British American Tobacco, a very popular company in this industry, Japan Tobacco, Imperial, as well as a few others that we have reviewed as well. Over the last year, now this includes reinvesting those dividends, that is the total return, they are down 3%. Now what we can derive from this graph is that they are in the middle of their competitors, but in fact the majority of the industry has had negative returns, as we can see. We have IMBBY up 1% with GAPAY, the only one with any significant growth over the last 12 months. When we extend this to the last 5 years, in fact, Altria Group again marginally positive over 7%. So what this effectively saying is that if you're not using those dividends for other things, taking it out, whether it's your own expenses, whatever it is, and you are reinvesting it, your growth over a 5-year period has only been 7%. When we then extend it to the last 10 years, we can see slightly better, up 90%. In fact, the second best performer, as we can clearly see here. But again, what we would say is not only is 9% not the greatest growth over the last 10 years, but past performance is never an indicator of future performance. So whilst they have this 90%, it doesn't mean over the next 10 years it will be the same. It could be a lot better, it could be a lot worse, or it could be roughly in line. Now, another thing that I wanted to do was just to compare it to the S&P 500. Now, I know there will be different investors, so they will have different goals. You have those who maybe invest in the S&P for the longer term, whereas those who invest in Altria just for the income. But I thought this is quite an interesting thing to see. Now, this is total return, so this is if you reinvest those dividends. S&P 500 over the last 12 months up 21%, Altria Group down 3%. When we extend it over the last 5 years, what we can see, a very large divergence, S&P up 73, Altria up 7%. And again, when we extend it even further to the last 10 years, whilst the gap is smaller over the last 10 years than the last 5 years, still we can see significant growth in the S&P over Altria. Now again, this isn't to compare them. As I mentioned, it is important. I do understand different investors will have different goals, but if you are a longer term investor, then this may not particularly be one for your portfolio. But again, let's keep going and understand why it may also be a very good opportunity. In terms of looking at insider ownership, well, we have 0.09%, very small, with only one really meaningful buy over the last 12 months, although you could argue it is fairly small. As always, with insider buying, we do note that it is bullish management buy if they do believe the share price will go up. And when we do take a look, in fact, we can see that that buy was by the director. It was at the back end of 2023, and it was for around $48,600 worth. We can also note some US Congress members buying and selling, nothing really notable to note, but again, like to be transparent whether it's a small buy or a big buy. But let me know below if any of this insider buying or selling is something you use as part of your own investment analysis. In terms of institutional ownership, 57.41%, we see $5.4 billion worth of sales by the institutions over the last 12 months. A lot more buying by these institutions over the same time period, with a massive buy in Q2 of around $51 billion. Now again, when we look at the more recent quarter in 2023, we see more selling than buying. In Q1, again, we don't have the full data set, but we see a little bit more selling than buying. Interesting to note, over the more recent quarters, Q4 and Q1 of 2024, a little bit more selling by the institutions. However, over the last 12 months, we see a lot more buying. Now, a few things that we want to point out about Altria moving forwards, and this has been taken from their Q4 2023 earnings conference from a few months ago, is looking at their forward guidance. Now, this is going to be interesting because they have in fact changed this guidance now. We will touch upon that as well. Essentially, in terms of moving forwards, they expect their full year FY 2024 guidance to have been $5 to $5.15. This was on the basis of those results that they recently had. And as we can see, the expectation would have been for EPS growth of 1 to 4%, depending on where they would have fit within that range, given FY 23 was $4.95. Now, any shareholders of Altria or anyone who is interested would have heard about something that they did release not too long ago. And what they have essentially done is they have sold a little bit, as we can see, of their shares in I'm not going to be able to pronounce that, but as we can see, ticker symbol BUD if you do want to go and check that out. Now, what they are doing with this money, there are a few things. The first thing, in fact, they do quite talk about how they want to return a lot of excess cash to shareholders, and we do talk about that through those share buybacks, is they are announcing an increase 2.4 billion on top of the existing 1 billion share repurchase that they had programmed for FY 2024. So that is a lot of positive news for shareholders. As we always say, when companies do a lot of share buybacks, it does return excess cash because you then get a larger portion of the company as they do reduce those shares outstanding. We will take a quick look at that graph as well. The second piece of good news that we do have from this release that they did not too long ago is that they are extending their forward guidance for FY 2024. And what we can see, they now believe, just to remind you what it was before, $5 to $5.15. They are now increasing this. And what they do say here is around 505 to 517, representing around 2 to 4.5% from their base in FY 23. So lots of good news. In fact, we did see the share price increase after this press release. It has now come down, so it could be a very strong opportunity for you to consider adding to this position, or at least one to consider or put on the watch list. Now, the other thing that we do want to talk about before we do jump in, we do want to remind you that their dividend gold is mid-single digits year on year, which when you do comprehend that when they are giving a dividend yield of 9.5%, is very positive for those who are more income investors and take the dividends, as we mentioned earlier, in income and use it on any expenses. Now, before we look at the actual valuation as well as the metrics, we do want to talk about something that the UK has been talking about for a long time. And this is a UK smoking ban. It has been talked about in other countries as well, like New Zealand. Let me know in your own country if there are any of these talks as well, or if they have implemented. What this essentially means is that it will restrict the sale of cigarettes to people in the UK. And we can see here quite clearly, people born in or after 2009 will never be able to legally buy cigarettes, and it will be essentially a ban. They also talk about a lot of fines that they're going to introduce to stop this happening, but effectively it will mean that companies like Altria Group, like Philip Morris, will have to start to move away from these nicotine products, which a lot of them are doing. Philip Morris are doing a very good job at this, and we can talk about them in an upcoming video. But again, there are risks, regulatory risks like this associated with companies not only in the tobacco industry, but across the board of companies that do essentially produce harmful products. Let me know, however, your thoughts in the comments below. Now, before we look at the metrics, just to let you know, we have released our latest free weekly article, 10 stocks with massive upside, a lot more other articles, undervalued dividend stocks. If you want to read this, all completely free, do click on that pinned comment below and you can start to read. Now, dividend safety, very important for this company. A lot of people are attracted given the high yield, 9.5%. We see a borderline safe score, 55. We're going to touch upon the metrics that support that. Market cap, 71 billion, is a large cap company. Now, in terms of looking at those metrics, the last recession, well, they increased the dividend during the 07-09 crash. They had below average growth, negative 50%. The S&P had around negative 12. But look, they massively beat the S&P, negative 20% return, when the S&P came in with a negative 55. Now, this is just data there for those who do see a recession inbound sometime soon. As we mentioned through their investor presentation, through their press release, what they are aiming for is mid-single digit dividend increases year on year. Now, 4.3% last summer. Why do I like this? Well, you are getting a yield not over 9%, around 9.5%, but you are also getting an increase in line with inflation. As we always say, a minimum of 4% on those dividend increases. So very positive. Over the last 5 years, 5%, again, very positive. Imagine getting an increase to a dividend in line or just above inflation whilst also getting a very nice yield. Over the last 20 years, though, not the greatest. As we said, 2% year on year, below the 4% target. Now, they are also a dividend king. They have been increasing those dividends for the last 54 years. Dividend yield theory, then, for those that are new or the first time or those that want a reminder, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign of undervaluation. We also have another sign of undervaluation with the forward P sitting below the 5-year average. But as always, we don't look at any of these models in singularity. We do conclude towards the end. And we can see consumer staples sector P much, much higher at 18.9. Now, in terms of free cash flow, this is one of those that correlates to dividend safety, and we do focus on that. We tend to ignore earnings, which is susceptible to manipulation by management through accounting, and the free cash flow does let us know if there are any need to be worried about any impending dividend cuts. Below 85%, now that is what we look for tobacco companies, and what we can see since 2018, it has been below that. 2023 at 63%, looking very healthy. 2024 below 85%. It is looking to increase to around 79%. Nonetheless, still below that target, so no worries whatsoever. Free cash flow per share, well, it has been increasing. This is important with a company, especially a dying industry or a supposable dying industry. With free cash flows, you want it to continue to increase. It has increased over the longer term, but we do know FY24 it is expected to drop down to just under $5, so we will incorporate that within our margin of safety. In terms of sales growth then, this is what we're trying to make you understand, is the sales over the last 10 years hasn't been the greatest. Around that 3 to 7% level has been very tough for them to achieve. Over the last 2 years, negative growth. So bear that in mind. It's okay to invest in companies that aren't growing, but you need to understand in your own projections and factor that in, because this isn't a company that we're going to see like a tech company or like Coca-Cola with the consistent revenue increases. This is a company that not only is inconsistent, but year to year we can see negative growth. Over the longer term, as we did run through earlier. Now, shares outstanding, as we mentioned, it does return that excess cash. Not only has it been decreasing over the longer term, but they are continuing to do a lot more share buybacks. In fact, increasing that 1 billion, as we mentioned earlier, to around 3.5, with that additional 2.5 boost from the sale. Now, ROIC, very, very strong. We want to see a minimum of 10% just to give us faith that management are able to effectively allocate their capital. Not only is it above that consistently, but it has been increasing. When we've compared this to companies like British American Tobacco, it is much lower. This has a very strong ROIC, but do go check out our previous videos on BTI so you can compare. Operating margin, again, not only above 25, but operational efficiency, they've been increasing it over the longer term. Free cash flow margin, the same can be said. They are increasing the margins year on year. Very positive on both accounts. Finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. This will also correlate to dividend safety as well as balance sheet strength. Below 3 for tobacco companies. In fact, below 3 every single year over the last 10 years. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.79 FY23, expected there or thereabouts in FY24. So personally, looking at this information, the free cash flow payout is still below 85%. The net debt to EBITDA is still significantly below 3. The industry as a whole, whilst it is slowing down as we can see and the free cash flow is reducing, it doesn't look like the dividend cut will be coming for this company in my opinion. It does look safe for now based on this information, but do let me know if you have different thoughts. As always, if you are enjoying the video, enjoying this episode, taking value, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's now jump into the valuation. So we have the first model, Graham's valuation, the earnings per share, long-term growth rate per analyst estimates, and the AAA corporate bond yield. As we can see, we have our first signal of undervaluation. Do bear in mind, though, we don't look as well at any of these models in isolation. Second model, the multiples valuation model, those companies in a similar sector and size. We have their PEs, we have the average PE multiplied by the EPS of Altria Group to get intrinsic value, the second showing a strong undervaluation. We then move on to the third model, which is the dividend discount. Now, average growth over the last few years, as we can see, what I like to see, 4% or just above, so at least in line with inflation, whilst getting that dividend as well, which is 9.5%. Forward looking, I've been incredibly conservative, below 1%. When we get that, we get an intrinsic value, again showing some strong undervaluation. In terms of the DCF model, as we can see here, free cash flow growth year on year, average at 12%. Even last year, they saw a nice increase of 13%. I would say this is fairly conservative. Negative 4% is what we have predicted based on this model, even though the average is around 11.6%, and last year they did increase. So based on negative 4%, in conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and again, intrinsic value showing undervaluation. So the intrinsic value here is just the average of those four models that we ran through in today's episode of Altria. And as always, you can click on the pinned comment below so you can grab a copy of this valuation model, get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. Margin of safety then, 10% is what we always start off with, and we only execute on that if it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price. And as we can see, it isn't at a 20% MOS level just yet, between 15 to 20%. Now, in terms of Wall Street and their forecast over the next 12 months, they have a price target of just under $47, upside of 13%, which if you consider it whilst getting a yield of over 9%, it could be one to consider for the portfolio. Now, as always, do let us know your thoughts in the comments below. Personally, as I mentioned, this is one that I do hold. It is one that I will start to consider buying if we do see it back down to around a 20% margin of safety, below $40, around the $39 mark. However, this will be an investment that will be different for different investors. Some will like the income. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. Don't forget to let us know your thoughts. And as always, we'll see you all on the next one.